What if I told you that while every retail investor was panic selling one of the most followed electric vehicle stocks on the planet, the so-called smart money was doing the exact opposite, quietly, methodically, and at scale, building a multi-billion-dollar floor beneath it? Welcome back to Smart Stock Sam, the channel where we cut through the noise and follow the data, not the hype. Today, we are going deep on NIO, and if you have been sitting on the sidelines wondering whether this is the moment to act, I want you to buckle in, because the data we are walking through today is going to completely reframe how you see this stock. We are answering the question every serious investor is asking right now: is NIO a buy or sell before earnings? And where exactly is this stock headed next? By the end of this video, you will have every price target, every technical level, every fundamental catalyst, and a complete picture of why this setup may be one of the most asymmetric trade opportunities of the entire year. We are covering the institutional floor, the delivery acceleration, the infrastructure moat, the global expansion strategy, the DCF valuation gap, and the exact technical mechanics that could make this move explosive. Let us get into it. Now, in every market, there is always a battle playing out between two forces: the fundamental signal and the macro noise. The fundamental signal is the actual internal health of a business. The macro noise is everything else: geopolitical headlines, central bank whispers, GDP targets, oil price spikes. Most retail investors cannot tell the difference. They hear the noise and they sell. The smart money hears the signal and they accumulate. Right now, with NIO, that gap between signal and noise has never been wider, and that gap is exactly where the opportunity lives. Our strong buy thesis on NIO is not built on hope or hype. It is built on 3 specific operational forecasts we made, and every single one of them has just been confirmed by the latest data. Is it possible the market is simply wrong about this company? The numbers suggest exactly that. Let us start with the one that might shock you the most. We predicted a recent surge in institutional accumulation, and the numbers just came in. When you see a firm like UBS Asset Management increasing their NIO position by nearly 4,000%, you have to ask yourself, what do they know that the panicking crowd does not? Institutions of that size do not make 4,000% position increases based on headlines. They make those moves based on multi-year fundamental models. They are not looking at next week's price action. They are positioning for the re-rating that comes when the rest of the market finally wakes up to what they have already calculated. And that brings us to the second confirmed prediction: the death of the cash burn narrative. For years, the single biggest bear argument against NIO has been that they burn cash like a furnace with no bottom. That story is officially over. Management is now guiding for their very first structurally profitable quarter in company history, projecting an adjusted operating profit between $102 million and $175 million. Think about what that means. The company that every short seller on Wall Street has been betting against is about to post its first real profit. When that number gets confirmed publicly, what happens to every single bear thesis that was built entirely on the cash burn story? And here is the third confirmation that most analysts are completely sleeping on. NIO just secured $330 million for their GeniTech chip subsidiary, valuing that single unit at over $1 billion as a standalone entity. That is a unicorn sitting inside a stock the market is pricing at the garage sale price of $4.78. They are actively de-risking the balance sheet in real time, and almost nobody is paying attention. So if all 3 of those forecasts came true, why is the stock not already at $6 or $7? This is the most important question in the entire thesis, and the answer is brutally simple. The market got hit by 2 black swan events in the same week. First, geopolitical escalations in the Middle East sent crude oil screaming past $90 a barrel, triggering a violent rotation out of growth stocks globally. Then, Beijing set a GDP growth target of 4.5 to 5%, the lowest since the 1990s, sending a shockwave through the entire Chinese technology sector. This macro 1-2 punch forced NIO shares to a low of $4.41, actually triggering our $4.73 hard stop loss before the stock bounced back to $4.84. Here is what you need to understand. That sell-off had absolutely nothing to do with NIO's business fundamentals. Zero. It was a pure, market-wide panic event. And in hindsight, it may have been the single greatest gift to long-term bulls this entire year. Because while the price was falling, the actual delivery numbers were going in the completely opposite direction. NIO delivered over 20,000 vehicles in February alone. That is a 57.6% increase year over year. They have now crossed the 1.04 million cumulative delivery milestone. But here is the hidden number that changes everything. Deutsche Bank order channel checks indicate that early March orders have already rebounded to a run rate of 3,500 weekly units. While every other EV maker is fighting demand headwinds, NIO is actually accelerating its order intake. Does that sound like a company you should be panic selling at $4 and change? Could it be that the single best buying window of the entire NIO cycle opened right when the macro panic was loudest? And the reason customers stay inside the NIO ecosystem once they enter it comes down to infrastructure that is almost impossible to replicate at any speed. NIO has now completed over 100 million battery swaps across nearly 3,800 operational swap stations. Think about what it means to pull into a station and swap your depleted battery for a fully charged one in 3 minutes flat. That is faster than filling a gas tank. Competitors would need billions of dollars in capital and years of operational lead time to build a network that even approaches this scale. The switching cost for NIO customers is enormous, and it creates a structural moat that the market is completely failing to price in at current levels. You would need to be irrational to walk away from a 3-minute battery swap for a 45-minute charging session. That is not a preference. That is a behavioral lock-in. Now add this on top. The company just produced its 2 millionth electric drive unit and is launching the NIO ES9 on April 9th. Featuring a proprietary intelligent driving chip and a steer-by-wire system that puts it in direct conversation with the most advanced vehicles on the planet today. Simultaneously, they are launching the Firefly brand in Thailand to capture the right-hand drive market and pivoting to an asset-light distributor model across Europe to sidestep tariff barriers entirely. This is not a struggling startup scraping for survival. This is a global technology company executing an aggressive multi-front expansion strategy while simultaneously hitting profitability for the first time. So, what is any of this actually worth? Here is where the numbers become almost uncomfortable. The stock is currently trading around $4.78. Wall Street's conservative consensus price target sits at $6.83. That alone is a 43% immediate upside just to reach what even the bears are willing to admit the stock is worth. But our intrinsically modeled discounted cash flow analysis puts fair value at $18.27. $18.27. That is a near 400% gap between where the stock is trading and what the underlying business is actually worth when you model it properly. The market is pricing NIO like a company on the verge of collapse. The data shows a profitable, global, infrastructure-backed technology company on the verge of a violent re-rating. Now let us look at what the recent price action is telling us on a purely technical level. On March 5th, shares dropped over 2% on those China GDP headlines, but on March 6th, the stock rebounded, and critically, volume came in 35% below the daily average. Do you know what that pattern signals? When a stock bounces on low volume during a broad market panic, large institutions are not selling. They are holding the line, waiting patiently for the catalyst they have already positioned for. And what are the odds that catalyst disappoints after everything we have just walked through? And that catalyst is the single biggest event in this entire trade. The audited fourth quarter 2025 earnings call hits on March 10th. The entire market is watching for one thing: confirmation of that structural profit. If NEO walks out and confirms that $102 million to $175 million adjusted operating profit, the cash burn narrative does not just weaken, it dies permanently on live earnings in front of the entire market. And when a multi-year bear thesis dies on live earnings, what happens to the stock price? It does not just go up, it gets squeezed. Here is why. There are currently over 147 million shares sold short against NEO. With 3.6 days to cover, any positive earnings surprise creates an immediate liquidity trap. Short sellers cannot exit gracefully. They are forced to buy back shares at any price, and that forced buying creates a feedback loop that can move a stock violently and rapidly. And if that short covering rally starts, it collides directly with something that turns it into a full-scale rocket launch. Call options represent 70% of the current options volume, with the heaviest open interest concentrated precisely at the $5 strike price. That is the gamma wall. The moment price breaches $5, market makers are forced to buy shares to hedge their options exposure. Mechanical, automatic, unstoppable buying that accelerates the move aggressively toward $5.50 and beyond. Here are the exact levels you need to watch. Our entry zone is between $4.70 and $4.78. Our absolute key support floor sits at $4.50. To the upside, first resistance is at $4.93, followed by the 200-day moving average at $5.24. Path A for next week is the conservative target, $5 to $5.15, triggered by reclaiming the 50-day moving average and breaking initial resistance. Path B is the explosive target, $5.50 and above, triggered strictly by an earnings beat that ignites the combined short covering and gamma squeeze mechanics simultaneously. Before we close, something important. Nothing in this video constitutes financial advice. All price targets, trade setups, and analysis presented on Smart Stock Sam are strictly for educational and informational purposes. Investing in individual equities, particularly in volatile sectors like electric vehicles, carries significant risk, including the potential loss of your entire principal. Always conduct your own thorough research and consult a licensed financial advisor before making any investment decisions. Past analysis does not guarantee future results. Here is the final verdict. Macro shocks created a temporary price deviation, but NEO's fundamental operational momentum is entirely intact and arguably stronger than at any prior point in this company's history. You have confirmed institutional accumulation. You have first-ever structural profitability on the immediate horizon. You have accelerating deliveries, an infrastructure moat that took years and billions to build, a global expansion strategy firing simultaneously on multiple fronts, a valuation gap so wide it is practically absurd, and a technical structure loaded with short covering and gamma mechanics primed to amplify any upside move. The coiled spring is wound as tight as it gets. March 10th is the potential release valve. The question is not whether this re-rating eventually happens. The question is whether you will be positioned before the numbers hit the wire. Now I want to hear your take. If NEO confirms that first-ever structural profit on March 10th, do you think the stock can breach $5.50 by end of next week? Or do you believe the macro headwinds are too powerful to let it run? Drop your honest analysis in the comments. This community has some genuinely sharp minds, and I read every response. If this deep dive added value to your research process, hit the like button right now and do contribute towards making this video rank in Hype Leaderboard. It genuinely helps Smart Stock Sam reach more serious, data-driven investors like you. And if you are not yet subscribed, now is exactly the time, because our earnings reaction video drops the moment those numbers are out. Stay sharp, stay objective, and I will see you on the other side of earnings.